Giordano, you've written about the market psychology surrounding high profile initial public offerings like SpaceX. What patterns do you consistently see after these major initial public offerings? And how should investors think about separating them from a long term opportunity?
Well, I think it's such a great question, and the SpaceX IPO is such a perfect microcosm of this dynamic of market psychology and capital flows. And I really think these IPOs follow a pretty consistent and repeated pattern. We see an initial price spike created by hype, and so there's a spike in price and volume. But then over time, as early insiders begin to sell and stock unlocks, price bleeds out into this large drawdown. And then, if the fundamentals are okay for a company, even though it's good, it's down 50 to 60%. But at that point in time, a base forms, and that's when the institutional buyers step in. So we see this big price spike, we see a bleed out, and then we see a base form over time. And SpaceX seems to be following this to an extreme. We saw a rally from 150 to $220 in the first couple of days of it. But then we're starting to see a sell-off, and there's more dynamics to come, but um, I expect it to bleed out. And these past IPOs, even with good companies, have gone down 50 to 60% in the first year from the IPO price. That's been a consistent pattern throughout time, and I expect that to play out again with SpaceX.
And as insiders, as the lockups on insiders expire and the shares are now tradable in the market, what does that do to the supply of the shares, market sentiment, and how does that impact the price? And then how do you distinguish between a temporary IPO correction and a long term shift in the rough price of the security?
Right. So with SpaceX as an example, we're going to see we started out with pretty low float, only several billion of stock floating out there in existing supply. But starting in August, we're going to see that supply ramp up and new stock unlocks come in. So it's going to start in August, and then it's going to continue through Q3 and Q4 and everything. And this is just a major, I mean, it's pretty clear, it's just a major increase in the supply of stock existing on the market. And you've got a lot of these early insiders that, they purchased SpaceX, these venture capital firms, these major investors. They bought it when it was worth 10 billion, 50 billion, 100 billion. And now the market cap's at 2 trillion now. So a lot of those people are going to lock in their gains, and they are going to start selling. And that's where I think the price bleed that is so endemic to IPOs play out. Now, in terms of whether this is just an IPO correction or a long-term decline, it really is going to depend on the fundamentals of the company. I think it's kind of simple. If there's earnings growth, it's going to do well. If there's not earnings growth, it's not going to make it. So we'll see how that plays out with SpaceX. They've got to start developing positive earnings. If they don't, then they might be in trouble. But really, the main factor for me is I trust the market. I don't think it's perfectly efficient, but I trust it in that price is the major indicator. And if it starts forming a base, a substantial base, that will tell me that institutions are buying in and that there's building conviction that this might be a good IPO, like the Google IPO from 2003, 2004.
The options market opens shortly after initial public offerings. How does that play a role in changing market dynamics, and the way investors position in these new stocks?
I think it's a fantastic question. After, I think it was Tuesday, the 27th of June, when the option market opened up. Now, at that point, the SpaceX IPO spiked up a considerable amount. But when the option market opened up, it crashed back down to 150. And this is a severe sign that option hedging is playing out. We saw a lot of open interest open up in the options market for SpaceX as an example. And what we're seeing there is a battle between retail investors and early insiders, because retail investors are, YOLOing into calls, trying to play for the upside on SpaceX. So they're trying to YOLO into calls, encouraging a gamma squeeze. But I think the winners and the main factor there are the early insiders who they cannot sell their stock yet. It's still vesting, but they are buying puts in order to hedge their position. So they're really buying puts, and that is forcing the market maker who's selling them the puts to hedge their own position. So the put demand is an indirect selling pressure, because the market makers have to short sell to delta hedge the puts that they're selling to the hedgers. So it's kind of like Mark Cuban in the dot-com bubble, where he had a bunch of Yahoo stock, and he was worried Yahoo was going to crash. He couldn't sell yet, so he put on a collar and he sold calls and he bought puts. And this itself has its own pressure on the SpaceX IPO. So I think we're going to see a bleed out, and SpaceX might go to $80 in Q4 or Q1 of 2027.
Many investors argue that artificial intelligence is either the next industrial revolution or just a giant bubble. How do you approach this debate without becoming overly ideological?
So I really think I'm more of a moderate, in that there's a both and here. Very often these industrial revolutions, and I do think it's an industrial revolution, it's going to have a productivity boom. Often these industrial revolutions come along with an investment cycle bubble. And so it's really more of a both and question instead of an either or. And we're seeing it play out with the heavy, I think it's like 2.5%, 3% of GDP spend that these major hyperscalers are having, where they are investing in building out these major data centers and building out compute. So we're seeing in a major investment cycle, we're also seeing a major industrial boom that is boosting the GDP of the US by like a couple percent. But I also believe that there's a market psychology point to be made here. There are, in a bubble, really market psychology becomes more important than fundamentals, I would say. And it really is about the aspiration, the speculation that people have, not necessarily the hard facts. Because, for example, in the dot-com bubble, it became distended from fundamentals, really. The PE ratios went to the moon, everything went to the moon. So there's a lot of anxiety right now about the heavy capex that these, major tech companies like Google and Amazon are having. But I think that is actually a brick in the wall of worry that the market can overcome. So if we're going to see more rallies, it'll probably be in the hopes of future profit rather than immediate results. I really think it is a buy the rumor, sell the news market. And, the jury's still out. So I think there's room to run.
You've discussed this idea that uncertainty can actually lead to higher asset prices. Why do markets often rally on expectations long before the fundamentals have proven themselves out?
Yeah, well, really, the market hates uncertainty. It just hates it. So it has to price something in, and nature abhors a vacuum, is another way to say it. So this uncertainty is really where people have room to hope. If the facts came in and the capex boom didn't produce revenue and it didn't produce productivity gains, and there wasn't enough demand for compute, if we find that out in the earnings reports coming in for the next few years, then that would just be sell the news and everything. So again, like I was saying, buy the rumor, sell the news. Markets will fill in the vacuum because they want to over extrapolate based on current facts. So markets are forward looking, but they're not perfect. So they're going to over extrapolate, and I think there's actually a lot of room for over extrapolation in this bubble, so to speak. The S&P and the Nasdaq have become a big AI bet. I think 20% of the S&P is now semiconductors, right? So it's just this big AI bet in the index. But the valuations, if you're not looking at Cape Shiller, or if you're not looking at market cap as a percent of GDP, the Warren Buffett indicator, if you ignore those and you look at my indicator that I like, it's forward PE. The forward PE multiple of S&P is like 20 to 21x. And for the Nasdaq, it's 24x, just about. And this is within the historical range, the recent history of the index. I want to see something ridiculous like 40x, where it's a bubble, it's distended from fundamentals, before I would expect that this AI boom has run its legs.
Looking back at previous technology cycles, what are some similarities and differences that you see in terms of this artificial intelligence boom as it compares to previous technology cycles?
Yeah, well, I think the classic comparison is the dot-com bubble. That's what everybody's comparing it to now. And we, like I was saying, we have this heavy data center capex and build out that's playing out, and it could be a repeat of the dot-com fiber optic overbuild, where they were building all these fiber optic cables for the internet, but the demand didn't show up. So there's a possibility that they are overbuilding and that there's not enough compute demand, there's not enough token demand to fulfill that build out. But an important difference is where the capex is being fueled, because in the dot-com bubble it was fueled by speculation, it was fueled by these companies issuing junk bonds in order to buy these assets. But the capex is run by these pristine corporate balance sheets from the hyperscalers, where it's just these mega corps like Google and Amazon that have massive free cash flow. And yes, they are issuing some investment grade debt, but really most of it is coming from that real existing cash flow. So I think that's a fundamental difference from the dot-com cycle.
Hyperscalers are committing enormous amounts of cash to artificial intelligence infrastructure. What indicators are you watching to evaluate whether those investments are creating durable value?
Right. So I'm not really an expert in the technicals of the capex build out, but as a simple participant, market participant, what I care about is just a simple indicator like AI token pricing and demand. If we see pricing for the frontier models and demand for those tokens to continue to go up and to the right, then I'm a happy camper. And right now we've still seen backlogs and bottlenecks, and that's not really the type of concern that you would have for a capex build out. So we see backlogs in memory and in semiconductors. So the demand right now is still there, but really over time, what I want to see is the AI tokens that people are spending on. I want to see the demand for that to continue to increase, and I want to see the frontier models, especially compared to the open source models, continue to have pricing power.
You've spent a lot of time thinking about U.S. fiscal dominance. How do you define that concept, and why do you believe it matters for investors over, let's call it, the next decade?
Yeah. So what is US fiscal dominance? Well, US fiscal dominance is basically the fact that the state, the government on the fiscal side, is spending so much that they are having a major effect and, in fact, dominating the economy and the markets. So, a major fact that I think about in tracking this is the deficit as a percent of GDP. So, you can look up the history of it. Anybody that's watching, the deficit as a percent of GDP of the US blew out to 10% during the Great Financial Crisis. That was, of course, because the GDP was going down, and the government was doing stimulus to bail out the banks and everything. So they were spending. So the deficit blew out. But then we had a quiet period in the 2010s where disinflationary growth dominated, and we returned to 2 to 3 to 4% deficits as a percent of GDP, where deficits are kind of normal since the Clinton administration for the US economy, but they were still quite low relative to the GDP. Then the next chapter was COVID. COVID actually blew out the deficit as a percent of GDP to 14%, which was higher than the Great Financial Crisis. So even though we avoided a recession at that time, they had such a massive fiscal impulse that it blew GDP deficit to GDP to 14%. But here's the key factor there. After that impulse, we did not have much of a normalization. The normalization period has had us tracking to 5, 6, 7% deficits as a percent of GDP, not 2 to 4% like in the 2010s. So we've kind of normalized to a level where deficits are structurally larger than they were in the past, especially relative to periods of economic calm. We are at a deficit of 6% of GDP during an economic expansion. And I think that's rather abnormal in the current market regime that we're having, and it is having a severe effect on markets.
If structural deficits are the new norm, what are some second order consequences of that you believe investors are underestimating right now?
Right. So with the structurally higher deficits, they're propping up demand, right? Because it's not the same as the Great Financial Crisis, because in the Great Financial Crisis, they were recapitalizing the banks, but the banks didn't lend out that much relative to the recapitalization, so they didn't create much new money. Now it's all about these fiscal transfers, bloated entitlements like Medicare and Social Security. These massive fiscal transfers are going into the economy directly, and it's propping up demand. Now, if we don't have a prerequisite increase in supply of housing, investment, supply chain stuff, that might mean that we're in a situation where inflation is structurally higher over the next 10 years. During the 2010s, we were struggling to have 2% inflation. It was below 2%. It was such a disinflationary period. But ever since the COVID regime and these massive fiscal impulses, we've struggled to get inflation down to 2%. And that has had a significant effect on the market. And it's diluting the coupon yield on bonds. So even though bonds are yielding 4.5%, 5% now, the inflation rate has been higher, and it's been diluting that yield that we've been getting from bonds. So bonds are having a severe issue. Inflation expectations are still anchored, and they still expect 2% inflation. But if we have 2.5%, 3% annualized over the next 10 years, that is going to have a significant effect on the bond market. That's going to eat into the coupon that people are expecting. That's going to force people farther down the risk curve into high yield and into equities.
What challenges does persistent government borrowing create for the U.S. Federal Reserve in terms of its ability to execute on its monetary policy and achieve its objectives of price stability and full unemployment or full employment?
Right. So with the Fed, I think they're going to have a credibility crisis basically because they can't control the fiscal side. Jerome Powell said that we are on an unsustainable fiscal path. That's what he said. Now, he can say that all he wants, and Warsh might say the same, but they can't control the Treasury. They can't control how much the government is borrowing with these deficits and how much they're spending. So if the government is trying to run a run it hot kind of nothing stops this train growth regime, that's going to lead to structurally higher inflation, I guess. And we have that compounded with the fact that there was this refinance wave in 2020 and 2021 where people were getting these cheap mortgages at 2 and 3%, and corporations were refinancing at these low rates, um, making them durable and not susceptible to these higher interest rate hikes that the Federal Reserve has been doing. So, really, especially with Warsh now coming in, he said that they've been focusing on the interest rate as their main tool of use. Well, they cannot control the fiscal profligacy. They can't control it. And so that means they can't really tamp down on demand as much. And they can't control the refinancing wave. So they're in trouble if they think that the interest rate is going to really determine what's going on with inflation and price stability. I also think that we have a counterintuitive problem here where, and people like Lynn Alden have been talking about this, where if they raise interest rates, that will blow out the deficit even more, right? Because the interest expense has become a significant part of the deficit. So if interest rates go up even more, the deficit's going to blow out even more and provide another fiscal transfer to uh, domestic savers and institutions who are receiving that interest income into the economy. So they are in a very counterintuitive, difficult bind here. And I think the Federal Reserve's credibility has more of a storm over the horizon.
U.S. Treasury market issuances continue to expand and persist. How do you think investors should evaluate the long-term implications of this as it impacts interest rates and capital allocation?
Right. Um, with Treasury issuance, it's been increasing. They have to finance this deficit somehow. So they have to finance this 6% of GDP deficit somehow. And the $1 trillion question is who's going to finance it? Because the foreign sector has been scaling back. I thought, China has been scaling back on their treasury ownership, and others have as well. Who is going to backstop it? Is it going to be the domestic savers? Are they going to clear it at the current interest rate? They might demand a higher interest rate in order to clear all this dilution and this heavy issuance from the Treasury. Now, Bessett complains that Janet Yellen didn't term out the debt when interest rates were lower during COVID, right? He complains about that because she had issuance front loaded at the front end of the curve in short term paper when she could have termed out the debt when interest rates were near zero. But Besant is in a bind now where he can't do that because he doesn't want to finance the government 10 years, 30 years out at 4.5%, 5%. So we might enter a period where they choose to do yield repression. It might not happen under Warsh, but in the not so distant future, we might have a Democratic president appoint another Janet Yellen or something like that, and we might have them choose to cooperate with the Treasury at the Federal Reserve, buy these bonds, keep interest rates artificially low, suppress yields relative to inflation. And that would be a regime of financial repression where bondholders are essentially being diluted. So I think there's significant tail risk in the Treasury market going forward. And this has a big impact on whether investors are going to exercise capital flight.
The traditional 60/40 portfolio has served investors for decades, 60% equities, 40% bonds. Under what market conditions do you think this portfolio becomes less effective?
Well, we've seen it in the we've seen exactly how it has its reckoning in 2022 because we saw growth slowdown plus inflation. And so that means it had a correlated move down both in stocks and in bonds. So inflation has become the Achilles heel of the 60/40, and that has created a new problem that we haven't seen in decades. The 60/40 really benefited from the 2010s because it was disinflationary growth. That's a perfect regime, perfect backdrop for the 60/40. We also saw a multi-decade bond bull market going back to the 1980s where nominal yields have been trending down over the time, boosting bond prices. So we've really it's more of hindsight in that the 60/40 has done so well recently. But inflation, if inflation is 2.5-3%, that's going to eat into the bond portion significantly of the portfolio. I'm not expecting a 1970s oil spike or some crazy inflation like the 1970s. But even if inflation normalizes above the Fed's anchored objective of 2%, we might see some more problems. And we might see more problems in the even during a recession because of inflation. Let's say we have an oil spike again because of geopolitical reasons, and inflation goes up, but there's a demand destruction and growth goes down. Well, growth goes down, but inflation goes up. That mitigates the convexity of the bonds because bonds are supposed to rally when growth slows down. If inflation is still elevated, that will eat into the convexity of bonds, hedging your stocks during that period. So there are several tail risks with a 60/40 portfolio that I don't think have existed for quite a while.
Okay, and so if stocks and bonds are going to be more correlated going forward due to inflation, how should investors rethink the way they diversify their portfolios?
Yeah, a lot of major institutional managers have been rethinking the 60/40 given the backdrop since 2022. And I really think there's a simple elephant in the room, and that's gold. Gold has outperformed bonds even without a nominal yield over the long term since, let's say, 1990 or whatever. They have kept up with bonds even without a nominal yield. Gold has also been a major diversifier relative to equities. So it's not like you're just adding equity beta, you are meaningfully diversifying your portfolio. So people like Larry Fink and other institutional figures are now promoting new allocations like the 50-30-20, 50% stocks, 30% bonds, 20% gold, and alternatives like private credit. And we might see people go farther out on the risk curve if inflation is a little higher because, hey, the coupon yield isn't enough bang for my buck. I might as well go into high yield. I might as well go into private credit. I might as well go into gold, etc.
You've mentioned alternative assets as potential complements to traditional portfolios. What characteristics make that an attractive allocation in an environment of higher fiscal expansion and higher inflation?
I really think that other than gold, gold is considered a hedge against inflation. It rallied a lot in the 70s and 80s off the back of inflation, but it's a pretty volatile instrument. Um, so I consider gold to be an attractive asset class. Of course, not in the short term because it's had a parabolic run and everything, but in a situation of higher inflation and fiscal expansion, I would say that real estate becomes important again. I wouldn't necessarily say public real estate like REITs and everything. That's more of a duration play. And if interest rates don't come down, they don't do REITs don't do too well because they're so over leveraged. But really, brick and mortar real estate exposure, especially to commercial real estate, that might be an opportunity to produce income through rental and leasing income. It might be a hedge against inflation because institutional rent tracks inflation, and it'll still benefit from appreciation if there's economic growth. So in that environment, I really think that instead of 60% stocks, 40% bonds, if you're aggressive and you're young, you might go 60% stocks, 40% real estate. But there's also some other trades that I've been thinking of recently, and I thought it might be good to mention them as certain possibilities. Um, for example, with the SpaceX IPO, I consider that a clear opportunity to sell calls because this euphoric hype is going to create excessive demand for premium, for call premium, by these retail holders and these retail speculators. And the sellers, the early insiders that come in with the stock unlocks, they're probably going to put a cap on the price of SpaceX going into the future over the next year. So I really consider, as an option seller, selling some call premium on SpaceX to be an opportunity. I also think that there are, the hedge fund space doesn't have a good reputation sometimes because of underperformance. I actually found a manager that outperformed the S&P over a considerable amount of time, over 6 years, and his name is David Orr. He has a very interesting track record. He did really well in 2022, actually, when everything was down, and he's known more of he has more of an edge as a short seller, which is kind of ironic because short selling is kind of a zero-sum game. And he has more of a value investor philosophy. So I consider this guy to be kind of interesting because in a backdrop where growth, momentum, and high beta has really done well over the past few years and value hasn't done too well, he's somehow found a way to flourish. And he actually has an active ETF called ORR. And the reason I mention it is that, look, the index has become a major AI bet. It's become a big AI bet, and it's been a big AI bet, it's become a big bet on these large cap tech stocks. If you want meaningful diversification into international, into the value factor, into small cap factors, into low beta factors, then you might consider an ETF like that one to diversify your equity exposure away from the index. But in terms of hedging the index, like the NASDAQ or the S&P 500, I found that, well, in this era where 60-40 might not work as well, long short might be more of a way to hedge your equity exposure for your passive index exposure. So there are ETFs out there that are in structural decline and have structural issues with them. Think of these buffer ETFs, where they're these covered call ETFs, where they're selling the upside on the ETFs, on the index. Now, these don't work so well as a short because the borrow fee is really high. But on indexes like FXI, which is the China large caps, China has done terribly over the past decade, even though they've had an economic miracle and an amazing economic expansion. So that's an example of an ETF to short because of the capital controls and nobody wants to buy Chinese large caps. There's also a very interesting trade to hedge index exposure that I found, and it's called SDIV, SDIV. It's this super dividend ETF. Now, this ETF is paying out 9% yield of dividends from these companies. They select for the highest dividend companies. But the problem there is that with the high dividend, sometimes it's a sign of structural decline or major issues bordering on bankruptcy in these companies. So it reallocates to all these high dividend companies at the cost of principal depreciation. If you look at the chart, you'll see that principal depreciation of this ETF over time. But even if you adjust for the dividends reinvested, the annualized return has only been like 1% over the past 10 years. 1% annualized over the past 10 years on this ETF. I found that it's a very good hedge against your index exposure because it's giving you those correlated drawdowns with the index as the index goes down, but without the high returns. So those are some shorting ideas. Time will tell, will reward or punish me about these ideas, but I consider it kind of interesting. Another fun trade that I was thinking of is, the prediction markets are out and you can access them on interactive brokers. I was thinking a very clear trade idea is to long the Democrats for the midterms in the House. It's priced at 75% as of recording, but that doesn't matter if you think it's 100% chance. I won't go into the reasons behind that. There's several reasons to say that the Republicans might lose the midterms in the House and everything, but these are just examples of trade ideas that I've been developing over time, and I just wanted to share a couple of them to see, well, we'll find out if I'm wrong in a couple months.
What common characteristics tend to attract your attention when you're developing some of these trade ideas?
Well, with these trade ideas, there has to be a spirit of simplicity. I don't, I don't pretend to be extremely sophisticated. I want it to be, can I explain it simply? Can I witness it simply? And often I compare it to um, a pelican. Michael Cow popularized this idea of the pelican. The pelican sits on the pier, does nothing for a long amount of time, and then waits and waits until there's an easy scoop. There's an easy trade. There's an easy scoop of fish to just gobble up. So really, instead of looking at many trades and trying to allocate all the time, I'm really emphasizing patience, finding those big winners, and just simply going with those instead of trying to spread out too much and trying to expand too much. So really, like the pelican, just waiting for those simple ideas that come along that are very clear, and taking those and ignoring the rest.
Your investment process blends macroeconomic thinking with market psychology. How do you balance narrative valuation and risk management before you put money to work?
Right. I really think that humility matters, and that the market is your friend. The market will tell you you're wrong, and really it's a two-way communication, because you can think you can have edge, but if price goes against you, you're forced to change and readjust. So I really think that coming with it with a sense of humility is the most important, temperament to come around with. And price, as Druckenmiller says, price is the fundamental piece of information. If price isn't really telling the story that you expect it to be, then you just have to be accept that you're wrong and move on. So really, I'm more of an experimental person, where I have a strong conviction, a strong thesis, and I hold it lightly. And so I try it out with the capital. If I'm proven wrong, I skip out and I move on.
As you continue to manage outside capital, what principles are most important to you in building a disciplined investment process that can endure through different market environments?
I think that given the 60/40 portfolio and some of the issues it might have going forward, I really think that long short equity might have a golden spring, a renewal in it. Um, you know, these shorts that I mentioned, shorts like shorting SDIV or FXI, they really help in hedging your long exposure and covering those drawdowns, because during COVID, for example, during COVID, the spread between SDIV and SPY blew out in a good way. SDIV went down, the delta and the beta were way higher on SDIV compared to SPY. And so you actually benefited from a tail event like COVID, because of that spread, the gain you have on that spread. So really finding good shorts is not easy, but it's something that matters as it integrates into a portfolio. And good shorts will hedge the downside across those times when there's severe issues in the market. And I also think about the fact that, a lot of people have passive index exposure. How do we work with that? Well, I'm a big fan of return stacking. And return stacking really is about adding exposure to things that are meaningfully diversified away from the index and can optimize returns over time. So, really, an example of, for example, selling calls on SpaceX, that's a negative beta, negative delta, negative equity beta and delta trade. And so that really um, adds to your integrates with your portfolio really well if you're positive beta and you're just allocated to the index. So really looking at trades that overlay on top of passive index exposure that improve and optimize the portfolio as opposed to doubling down and getting more leveraged long, as an example. But those are some basic ideas, and really, again, humility is important in the investment process.